The Affirm consumer, that is the folks that we approve for transactions, and each transaction is separately underwritten. So we do have a very discerning eye as we underwrite these loans. They're doing great. They are shopping. Demand for our product is accelerating. We just posted another accelerating fourth in a row quarter of gross merchandise sales. They're doing really well. Repayment is really strong. Credit is steady to improving. And so we lend to a huge percentage of U.S. population. So you could infer from that US consumer writ large is doing well as well. So I think the rumors of the American demise are greatly exaggerated. That said, we continue to watch every metric we can all the time because that's what our job is.
Are those metrics stronger now, Max, than they were, say, a year ago?
Again, from Affirm's point of view, we really are firing on all pistons. Our ability to serve folks has improved about 20% year over year. That's measured in transaction frequency. Our user base grew about just north of 20% as well. So consumers are joining us. Our user active acquisition has accelerated for the sixth quarter in a row. So there is a meaningful secular shift from credit cards to Affirm. So I think, again, within our ecosystem, every metric looks very good and better than last year.
Can you talk a little bit about what transactions Affirm customers are using the payment system for? Are they using it like they would use a credit card right now? What's the typical transaction? What's the transaction size?
That's a great question. And it's a little bit differentiated between players, so I can only speak to us. The average ticket for us is just under $300. And that should tell you a lot. So everything from a truly considered purchase, like a nice bicycle, maybe a couple $100, all the way down to a large party supply, and maybe a couple $100. Those are sort of the bookends. We tend to believe that really, really low ticket items, $20 is just too small of an amount to finance with Affirm. So we have a notion of, where we start trying to tell our consumers, hey, this seems like a good idea to be a cash transaction. But generally speaking, because the product we offer is just so much better than credit cards for the end borrower, we're very pro idea that Affirm should be used in place of credit cards, full stop. If you think of it very quickly, it is an obvious idea. So we don't charge late fees, we don't compound interest, we don't do deferral or any of the sort of gimmicky things that look too good to be true because they are too good to be true. So it is an honest financial product that really helps the end borrower get full grip on their finances and not get into trouble, not get over their skis. So directionally, the more they use Affirm for everything, I think the better off the consumer is going to be. That said, the current average is $297, I think.
How often does somebody though miss a payment or they're late? And then what happens as a result? What kicks in? I'll be honest, I'm not a huge user.
Well, I mean, have you ever used it?
I think I've used one of them, and I can't remember once because I was curious about it, and I set it up so things just got paid, and it was like 3 payments or something because I was curious about it because we talk about it all the time here. Grew up where you could put stuff away, stuff on layaway. So it's interesting to see the evolution. But I am curious, Max, how often is it that somebody is late and then the terms start to change? And this is a business, right?
So that's actually. Thank you for that prompt. That is, let me try to make if there's one thing I can make clear in this conversation, I just really want to hammer this one home. Nothing will change. Terms will not change. Fees will not appear. Interest will not change. No dollar amounts will change if something happens and you can't make your bill on time. The fundamental promise of Affirm is what you see is what you get. Mm-hmm. When you're borrowing $500 and you're committing to paying, let's say, another $25 of interest, if you cannot make it on time, it will still be $525. There will not be a penny more. If you prepay and pay us early, that interest amount will come down. So it is a profoundly pro-consumer product. That said, I just wanted to make that very, very clear. Yeah. We are a better financial product. About 98% of our consumers are never late, never in default. And so it's fundamentally extremely, extremely high probability of none of that will ever happen to you if you're within the Affirm ecosystem. When folks are delinquent, which is a fancy term for late with their payment, we'll reach out to them. We use all sorts of digital channels to get in touch with them. We'll remind them. vast majority of folks that are late are actually what's called sloppy payers in the industry, where they say, oh my God, I forgot to set the auto pay. Thank you for using that feature if you did. And they cure it, and so it goes. And so that the reason we don't charge late fees is because for folks where they really cannot, something happened and they lost their job or something happened, they're not going to pay you any faster if they have no means of paying you back. The ones that are just stumbled somehow and forgot, the reminder is the most you need to do. You don't want to penalize them for being forgetful.
So what is the default rate?
It's on the order of 2% plus or minus.
That's remarkable.
Well, I think
it's meaningfully lower.
Yeah.
It's meaningfully lower than credit cards. By the way, our lower ticket items, that trends below 1%. So just to give you a sense, like the rumors of this being a bad financial product creating hidden leverage in a system is like bad math and ridiculousness.
So push back on that a little bit, but do it through the explanation of the business model here, because I think a lot of people approach this product with being informed about how credit cards work, and the idea that high interest if you miss a payment, fees if you miss a payment. In a sense, the risk is somehow put on a different party here, Max, and there's also buy-in from the retailer who partners with Affirm. Just explain how this whole transaction works.
Yeah, very simple. You typically find Affirm at a point of sale on any online and now progressively more offline merchants. You will ask to use the product, so it's always an explicit request to borrow, and we take great pride and put a lot of technical emphasis on underwriting every transaction individually, so that we have the discretion to say, hey, you're overextending yourself. These 2% through 2.5% default rates don't come for nothing. It would do an enormous amount of work in this underwriting engines that we've built. So as you get approved through your real-time application, of course, what happens, we pay the merchant and you commit to paying us back over time. And we always give you a menu of choices. Could be anything as short as 4 payments every 2 weeks, could be as long as 36 months, once every month. The rest of it happens more or less automatically if you opt into the auto pay feature. If you don't, we will send you a reminder and then you arrange for repayment from your bank account typically. And that is it. In our case, there is no compounding. The interest is the interest expressed in dollars, and that is what you commit to. It will not go up independent of any modifications to the schedule. There are no late fees. In our case, again, we are unique, or almost unique, I think, at this point in the industry by just not charging any incremental fees at all, and so on. And so this really is the product where the cornerstone value is transparency. We are entirely transparent with every participant in the ecosystem, from merchants to consumers. Everyone knows what they're getting into. You get your bicycle or your couch or your putty supply today, and you pay for it over time, and you know exactly when the payment plan stops, and then you're no longer in debt. It is a better alternative to credit cards, because when you use credit cards, which are very convenient, you don't have this extra approval step, so just drop the plastic and on you go. You're adding to this giant bucket of debt that just sits there and revolves. The interest compounds into principal every month, every week. Whatever it is you've accrued in interest becomes a part of the base that accrues interest on interest on interest. That is why credit cards are so expensive. The reason APR matters as a measure is because it doesn't just measure interest you'll pay on a principal, it's the interest you'll pay on the interest, and so on. The model we invented, the reason we are so important, the reason people are coming to us, frankly, is they don't have to understand exponential mathematics to figure out what is the true endpoint of interest will be. Whatever it is we promised them, that's exactly what they pay.
We're speaking with Max Levchin. He's the founder and CEO of Affirm, the $29 billion market cap fintech company. Also, you'll notice Carol, he keeps talking about bikes. He's a big cyclist too, so spends a lot of time on the bike.
So is Tim, by the way, Max. Hey,
oh, we know. We follow each other.
I know you guys do. hey, listen, one of the things I want to ask you, your stock is on a tear. It's up 50% year to date. It's surged as much as 25% intraday in response to your earnings, which you've been talking about. That came out late August. You had analysts, several of them raising the price targets on the stock. What's the path to sustainable profitability? What do you need to see happen to kind of keep the momentum going?
We just need to keep doing exactly what we've been doing. The joke I make all the time is we are an overnight success, 15 years in the making. Profitability is not an accident. We gave this date exactly a year ago where we said, look, 12 months from now, we'll be GAAP profitable. 2 years ago, we said, hey, 24 months from now, we expect to be GAAP profitable. And so we've been on a journey that we've planned years ago to deliver on all these milestones. And so the celebration isn't of some clever overnight idea that we've had and finally just poked our head from the unprofitable side of the fence. We've been planning to be profitable. We've delivered on this plan. We have said publicly we intend to be GAAP profitable from this point on. That is not a thing you can decide last week and deliver tomorrow. It's something that you build over a long period of time. It takes discipline, takes execution, takes a great team, which I'm lucky to have. And so I'm not worried about that whatsoever. Whatever we commit to, we tend to deliver on.
Well, speaking of time, it's been a long time coming for Klarna and its IPO, and it does plan that here in the United States. Competition in the space is definitely, Max, picking up. They are specifically rapidly expanding here in the U.S. You've got Sezzle. That stock is up about 7,000% in less than 2 years. There's a lot going on. So how are you seeing the competitive landscape evolve, and what does that mean for you guys specifically at Affirm?
We're very happy doing our thing. As I just extolled for a little while, we are different. We do our thing a little bit differently than the rest of the industry. We have a very strong point of view on what is and isn't moral, what is and isn't right for the consumer, for the merchant partners that we have. And it's paid great dividends for us and our shareholders. So in that sense, we intend to change absolutely nothing. Part of why maybe I spend less time looking at the competition than one does in a competitive industry, and this one is certainly very competitive, is in aggregate, buy now, pay later is still just under 1% of total US retail, and it's a worldwide phenomenon. And US is actually quite behind. If you look at markets like Australia and the Nordics, where buy now, pay later is more mature, there the penetration into e-commerce is on the order of 20-25%, I think. In the US, it's a much more polite 7% maybe. And if you expand it into offline, which there's no reason why this doesn't work offline. In fact, we have a card that's been growing extremely well, better than 100% year over year, just in the last quarter's report. We're a fraction of a fraction. So the opportunity to provide more honest financial products is, I said it in my shareholder letter, sort of tongue in cheek, it rounds up to infinity. And so for now, we're not really running into each other in the hallways, fighting for that last same customer or merchant. I'm sure one day we'll get to a point where it's so significant as a part of the U.S. economy where it becomes, a zero-sum game. But even in that world, there's a Visa to a MasterCard. And for now, I think we're all just experiencing really good growth. And frankly, the fact that the market now will support a couple of large publicly traded companies, probably a good thing. That just gives shareholders a sense for this has a long way to go in terms of growth.
Hey, Max, before we let you go, just 30 seconds on crypto and stablecoins. An opinion piece this week coming from Paul Davies of Bloomberg Opinion. He wrote that stablecoins are an opportunity for merchants and airlines to recover costs from big banks and networks like Visa and MasterCard. Is there a use for digital assets at Affirm?
I think there are interesting opportunities around merchant settlement, which is sort of, I'm echoing what this piece is saying. I'm not yet seeing consumers spending stable coins they have acquired in droves. And so as a back-end mechanism, stable coins are very interesting, and we're certainly looking at the opportunities there. On the consumer side, I think folks are thinking in dollars and probably will continue to do so.